Criticisms of the voluntary carbon market aren't new. There's always been legitimate concern that purchasing carbon credits allows companies to defer taking internal action to reduce their own emissions. And frankly, this is a concern that we share. Purchasing carbon credits to match your unabated emissions is not on its own a robust climate strategy. What's different now is the urgency of the climate crisis. Companies are facing heightened pressure to take aggressive climate action beyond their own value chains. And one of the most verifiable and quantifiable ways to do this is by purchasing carbon credits. When you look at the goals of the Paris Agreement and corporate climate targets, it becomes clear that carbon credits will play a significant role in mitigating climate change. But this means that there's increased scrutiny from stakeholders who want to ensure that carbon credits represent real and additional emissions reductions. We're seeing a renewed push to build consensus around what constitutes a high-quality carbon credit. One player in this space is the Integrity Council for the Voluntary Carbon Market, also known as the ICVCM, which published a first draft of its core carbon principles earlier this summer. These core carbon principles aim to set a global threshold standard for a high-integrity carbon credit in the market. We're also seeing the emergence of a number of independent ratings agencies, which look at specific projects and rate them against a variety of quality criteria. They then deliver those ratings to buyers to help inform purchasing decisions. Market stakeholders are also working to standardize how companies should talk about the purchase of carbon credits. One example of this is the Voluntary Carbon Markets Integrity Initiative, or VCMI, which published a code of practice this June that introduces a framework for using carbon credits in a net zero strategy. It provides a high ambition standard for corporate climate action and then standardizes how these companies should be talking about pursuing that action. The Science Based Target Initiative also plans to publish a white paper on purchasing carbon credits for what they call beyond value chain mitigation in 2023. It's not yet clear exactly what this white paper might include, but we hope to see guidance on a contribution-based approach to purchasing carbon credits. In other words, that means an approach that prioritizes maximizing climate impact over volumetrically matching carbon credits to unabated emissions. There are ongoing conversations around the specific roles and requirements proposed by both the ICVCM and VCMI, and it's not yet clear how either initiative will land in the market. On 3 Degrees' end, we submitted comments to the VCMI, and we also worked with our trade associations to inform collaborative feedback to the ICVCM. If these initiatives are successful, they will contribute to the goals of the Paris Agreement by ensuring carbon credits are real, additional, and complementary to comprehensive corporate climate action. They'll also ultimately increase buyer confidence in the voluntary carbon market, which in turn will increase the flow of finance to high-impact mitigation projects around the world.